You walk into a store, you grab a bottle of shampoo, maybe a new t-shirt, or even a prepackaged sandwich.
Right.
You look at the tag, you see the price, you scan the barcode at the self-checkout, and then you just completely ignore it.
Yeah, you throw it away.
Yeah, exactly. It's just packaging. To you and me, it is practically invisible.
Yeah.
But to a multi-billion-dollar company called Avery Dennison, that little sticker is basically a crystal ball.
It really is, yeah.
Today, we are cracking open their Q2 2026 earnings call for this deep dive. We want to see exactly what those invisible labels are predicting about the global economy, about inflation, and honestly, the next time you go to the supermarket.
And I think, this is the perfect lens for this document, because by the time you actually notice the price of your groceries going up, right, or you notice a shortage of a specific product on the shelf, companies operating at this base layer of the supply chain have already been navigating that exact reality for, a quarter or two.
Months in advance.
Exactly. A barcode or an adhesive label might seem completely mundane, but you cannot ship a single pharmaceutical product, a single car part, or a piece of apparel without one.
It's just a mandatory friction point for global commerce.
It's the ultimate friction point. Nothing moves without a label.
Which honestly makes their Q2 headline numbers pretty staggering when you consider the current economic climate.
Oh, absolutely.
Like organic sales growth accelerated 8%. And just to be clear on that term for you listening, organic growth means they expanded their actual day-to-day operations, right?
Yeah.
They're selling more labels and tags, not just, buying up other companies to artificially inflate their revenue.
Right. It's the real deal. It's actual underlying business health.
Yeah. And meanwhile, their adjusted earnings per share, or EPS, the profit allocated to each share of stock, it hit $2.89.
Which is huge.
A massive 19% jump year over year. And their free cash flow is just sitting at over $360 million.
Those are, they're incredibly aggressive numbers, because you have to remember, we are operating in a really volatile inflationary environment globally.
Very volatile.
In 2026, costs for raw materials remain stubbornly high. Labor costs have permanently reset upward pretty much everywhere.
Yeah, that's not going back down.
No, it's not. And then you add in geopolitical instability, which is a massive headwind for manufacturing. So a 19% jump in earnings per share, that does not happen by accident in that kind of environment.
It requires a plan.
It requires an incredibly disciplined corporate playbook. And that $360 million in free cash flow you mentioned is particularly telling.
How so? Why focus on the cash flow specifically?
Well, in a high interest rate environment, cash is essentially the ultimate strategic weapon.
Because borrowing is so expensive.
Right. It means they aren't drowning in debt servicing. They have the liquidity to invest in new technologies, while their competitors might be, pulling back or just struggling to stay afloat.
Okay, let's unpack this. Because moving from those big flashy numbers to how they actually pulled it off, that is where the real story is for me.
Definitely.
The transcript highlights that their materials group, which is basically the absolute bedrock of their business, delivered organic sales growth of approximately 10%.
A huge driver for them.
Yeah. And the CEO, Dion Stander, explicitly mentions two primary levers they pulled to make this happen. First, he cited low single-digit pricing realization.
Right.
And second, their productivity playbook. So in plain English, they raised prices slightly and they cut costs internally.
That's the basic formula, yeah.
But, I am skeptical here. Is passing inflationary costs onto customers a sustainable business strategy? It feels like if you just keep nudging prices up, you eventually hit a brick wall where the customer simply balks.
That is the exact tightrope every major corporation is trying to walk right now. You cannot blindly pass 100% of your cost inflation onto your customers indefinitely.
Right, because eventually they just say no.
Exactly. If you do that, demand disruption kicks in. The customer decides the premium isn't worth it, they find a cheaper alternative, or they just delay the purchase entirely.
Which kills your volume.
It kills it. So the key to analyzing this transcript is looking at the ratio between those two levers you just mentioned. Notice the phrasing they used. Low single-digit pricing realization.
Meaning they didn't jack up prices by 12% to cover all their internal problems.
Precisely. They instituted very modest, highly calculated price increases. They are basically asking the customer to absorb a fraction of the macroeconomic pain.
Just a little bit of it.
Right. But the heavy lift, the actual reason that profit jumped 19% comes from that second lever, the productivity playbook.
Okay. I always struggle with the term productivity playbook because, I don't know, just sounds like corporate jargon for firing people.
Yeah, it often is.
Right. But what does internal productivity actually look like in material science? Are we just talking about making the label paper thinner so it costs less?
Well, sometimes, yes. It does involve material reduction, which they actually call downgauging.
How engaging.
Yeah. But more often, productivity at this massive scale is about extreme operational engineering. Think about how an adhesive label is actually made.
Okay, like a giant factory setting.
Yeah, you have these massive vats of chemical coatings being applied to literal miles of paper or film, rolling through a machine at incredibly high speeds.
Right.
Productivity means investing in automation that reduces the setup time between different custom batches.
So less downtime.
Less downtime. It means using AI-driven software to optimize the cutting patterns on a master roll of material so there's practically zero physical waste left on the factory floor.
Oh, wow. That makes sense. Maximizing every inch of the material.
Exactly. It also means reevaluating global shipping routes so you aren't paying, premium spot rates for freight.
So they're fighting inflation by essentially tightening every single bolt in the factory.
That's a great way to put it, yeah.
But how do we know the customers aren't still furious about the price hikes? I mean, even if they were low single digit, nobody likes paying more.
True. Nobody likes it. But the proof that it's working is buried in a really specific data point regarding their high-value categories.
What does the transcript say about those?
The transcript notes these high-value categories return to mid-single-digit growth. And this is the crucial indicator here.
Because if they were mad, they'd buy the cheap stuff.
Exactly. If customers were feeling financially suffocated and rejecting Avery Dennison's pricing, you would see a phenomenon called trading down.
Trading down.
Yeah, they would abandon the specialized, high-margin adhesive labels and literally beg for the cheapest, most basic paper stock available just to keep their production lines running.
But they didn't do that. The expensive stuff is still selling.
Right. And that proves the customers are willing to swallow those slightly higher prices because the specialized product offers undeniable value to their own downstream supply chains.
So it's a massive validation of their pricing power, basically.
It is. It shows they have a really strong moat around their business.
Okay, well, the pricing power is impressive. But I did notice a massive caveat in the chief financial officer's notes.
The pre-buying.
Yes. As much as I want to applaud their internal productivity, some of this 10% growth in the materials group is actually a total mirage.
It is a bit of an illusion, yes.
And it's a mirage driven by pure, unadulterated global panic. The CEO mentioned their results benefited from continued customer inventory stocking.
Right, which sounds so benign.
It does. But then the CFO, Greg Lovins, quantified it. He said this customer pre-buying artificially added an estimated $0.25 to that $2.89 earnings per share figure.
That's a huge chunk.
Almost 10% of their massive profit jump was just customers aggressively hoarding materials.
The pre-buying phenomenon, it really is fascinating to see it play out in real time on a corporate balance sheet like this.
When I read that, I honestly couldn't help but think of the toilet paper hoarding of 2020.
That is the perfect analogy.
Right. People panic buying massive bundles of something they didn't immediately need just because they were terrified they wouldn't be able to find it next week.
Yeah, filling their garages with it.
Exactly.
Yeah.
But this is happening on a massive industrial scale. Why are sophisticated multinational manufacturing customers suddenly acting like panic shoppers in aisle 4?
Well, what's fascinating here is that the transcript gives us two specific reasons for this industrial hoarding.
Okay, what are they?
First, accelerating raw materials inflation. And second, customer concerns regarding surety of supply.
Let's break down the mechanics of that anxiety.
Yeah.
We are looking at a world dealing with persistent geopolitical friction, right? Specifically highlighted in Europe and Asia.
Yes, and that brings us to that phrase you mentioned, surety of supply.
Surety of supply. That just sounds like corporate speak for, I am terrified the cargo ships are going to stop moving.
That is the exact fear. It's not an abstract worry. It's an operational terror for these companies.
Like, give me an example of how that plays out.
Okay, imagine you are running a massive pharmaceutical bottling plant in Europe. Or, say, a textile factory in Southeast Asia.
Okay, I'm the factory manager.
Your product cannot legally or physically leave the factory without a label. The label contains the compliance information, the lot number, the routing barcode, everything.
So if I run out of labels, I can't ship the product.
You can't ship a thing. If you run out of that specific adhesive paper, your entire multi-million-dollar production line grinds to a complete halt.
Oh, wow.
You have workers standing around doing absolutely nothing, and you are missing critical delivery windows to major retailers.
So compared to the cost of a factory shutdown, dropping a few extra $1 million to buy 6 months worth of labels today is just like an insurance policy.
It is a purely defensive maneuver. They are locking in the current price to beat future inflation, for one.
Right, because they know prices are going up.
Exactly. And they are physically securing the material in their own warehouses so they don't have to rely on a fractured, unpredictable global shipping network.
It makes total sense when you frame it like that.
But here's the problem with all this hoarding. While it looks fantastic on Avery Dennison's Q2 earnings report,
Yeah, giving them that nice 25-cent EPS bump.
right, it creates a massive, massive strategic nightmare for the executives going forward.
Because they are basically borrowing sales from the future, right? I mean, doesn't that make this quarter's record profit technically a bad thing for the long-term health of the stock?
Well, it doesn't permanently damage the stock, no, but it introduces extreme volatility. And Wall Street hates volatility.
Wall Street likes a nice, smooth curve.
Exactly. And this hoarding leads to what the CEO calls the unwind.
The unwind.
Yeah. Eventually, those customers who hoarded all those labels have warehouses stuffed to the absolute ceiling. They realize the supply chain hasn't totally collapsed. So what do?
They stop ordering new materials entirely.
Bingo. They just slowly burn through the stash they already bought. This is called inventory destocking.
Okay, and the transcript notes management anticipates this destocking will happen primarily in the third quarter, right? With some carryover into the fourth quarter.
Yes, that's their projection.
Which means Avery Dennison knows a temporary sales drought is coming. The mirage is going to evaporate.
And predicting exactly when that evaporation finishes is an almost impossible forecasting challenge for management.
Because you're dealing with human psychology at that point.
Exactly. You are trying to guess the psychological comfort level of thousands of different procurement managers spread across Europe and Asia.
When will they feel safe again?
Right. When will they feel secure enough to let their safety stock dwindle back to normal levels and start placing fresh orders?
And if management guesses wrong?
If they guess wrong, they either overproduce and get stuck with their own excess inventory, or they underproduce and completely miss the rebound when those customers suddenly need labels again.
Man. So customers hoarding labels ties up millions of dollars in cash for everyone involved. The buyers tie up cash and inventory, and Avery Dennison has to prepare for a sudden drop in revenue. It really makes you realize that anxiety is incredibly expensive.
Anxiety is one of the highest hidden costs in business today.
But, if the base materials growth is partially this geopolitical mirage, we need to look elsewhere in the transcript to find growth that is structurally sound.
We do.
And that takes us to their solutions group, which saw 3% overall organic growth.
And within that group, the underlying dynamics are incredibly polarized. It's really interesting.
Yes, very polarized. Specifically, their Emblex platform, which deals with apparel and sports branding. It delivered robust, low double-digit growth.
A massive bright spot for them.
Right. And the driver they cited? Core market expansion and strong World Cup demand.
The World Cup effect.
Now, I have to be honest, I have a really hard time believing this.
Why is that?
We are talking about a global materials corporation pulling in billions of dollars. Surely a few million soccer jerseys is just a drop in the ocean for them, right?
You'd think so, yeah.
Are we sure this isn't just management using a flashy sporting event as a convenient narrative to, distract from slower growth elsewhere? How does a single sporting event, even one as big as the World Cup, move the needle so drastically?
I get the skepticism. It sounds hyperbolic until you really unpack the logistics of modern global merchandising.
Okay, unpack it for me.
You have to realize that the World Cup is not just a sporting event. It is a synchronized, massive, global retail mobilization.
Mobilization is a good word for it.
When we think of the tournament, we picture the stadiums and the broadcasts and the players.
Right, the games.
What we don't think about is the supply chain required to outfit hundreds of millions of fans in nearly every country on Earth simultaneously.
Okay, but at the end of the day, it's still just T-shirts, isn't it?
Not anymore. Modern athletic wear, especially when it's tied to a mega event like the World Cup, is highly engineered.
How so?
The Emblex platform isn't just printing simple paper tags that you cut off. They provide the external embellishments.
Like the logos and stuff.
Exactly. The woven crests, the heat transfers, the specialized sponsor logos. And crucially, they provide the hidden anti-counterfeiting security tags that are woven directly into the fabric.
Oh, wow. I hadn't even considered the counterfeit angle. The black market for World Cup gear has to be astronomical.
It's a multi-billion-dollar illicit industry. The major sports brands are fiercely protecting their intellectual property.
They don't want knockoffs undercutting their sales.
Right, so they require highly complex encrypted labeling solutions that cannot be easily replicated in a sweatshop.
And Avery Dennison makes those.
Yes. Now, consider the timeline of all this. The jerseys have to be on retail shelves globally weeks before the tournament even begins.
Right.
The apparel factories in Asia and Central America need to actually assemble the garments months before that.
Which means
they need the embellishments and the security tags delivered even earlier.
So Avery Dennison is feeling the financial wave of the World Cup a full year before the first game is even played.
Exactly. It creates a cyclical, highly concentrated earnings boom. Massive, highly specialized orders have to be fulfilled in a very tight, inflexible window.
Because the World Cup date isn't changing.
No, it's set in stone. So it's this hidden economy entirely dependent on the global fervor for sports. But like you mentioned, it is important to look at the contrast within the transcript.
Yeah, because while the sports apparel side is booming, they mentioned that another platform in that same group called Vestcom was down 3%.
Right. It is not a rising tide lifting all boats here.
It really highlights the extreme fragmentation of the global economy right now.
It does. Certain sectors are experiencing hyperdemand based on cyclical mega events, while adjacent sectors might be in a micro-recession.
So a multinational company has to maintain a really diversified portfolio just to weather those sudden shifts in demand.
Exactly. You need the World Cup boom to offset the Vestcom dip.
Which brings us perfectly to what I think is the most revealing part of this earnings call.
Let's hear it.
We just talked about the anxiety of inventory hoarding, right? And the complexity of tracking millions of World Cup jerseys globally.
Yes.
Both of those issues, managing massive inventory and tracking global shipments, lead directly to Avery Dennison's Intelligent Labels platform.
Ah, yes. The RFID rollout.
Yes, this is the enterprise-wide rollout of RFID technology. And for the listener, RFID stands for radio frequency identification. These are the labels that can essentially talk to computers and track inventory in real time.
Right. This is the technological transition that moves the label from being just a passive piece of paper with a barcode to being an active data node in a network.
It's wild. But the data here is fascinating.
Right.
Overall, intelligent label sales were up low single digits.
Solid, but not explosive.
Right. But when you look at the underlying sectors that use these labels, it is total whiplash.
Yeah.
On the boom side, you have apparel and general retail. Intelligent label sales in that sector were up approximately 10%.
Which tells us that brick and mortar retail is leaning aggressively into technology to solve their labor and margin issues.
They need the efficiency.
Yeah. As general retail recovers from previous slumps, they are deepening their program adoption. They want absolute visibility on every item in their stores.
But then you look at the logistics sector. The transcript explicitly states intelligent label sales and logistics were down double digits.
A massive drop.
When I read that, my initial reaction was just pure panic.
Yeah.
I mean, the logistics sector is the lifeblood of the global economy.
Yes, yeah.
If the companies who literally move boxes around the globe for a living are buying double-digit fewer tracking labels, is that a massive macroeconomic red flag? Like, does that mean global shipping is crashing and a severe recession is imminent?
That is a very, very common trap analysts fall into when looking at isolated quarterly data.
Okay, walk me back from the ledge here.
The short answer is no. Global shipping is not crashing, and this is not a macroeconomic red flag.
Okay, good.
To understand why logistics was down double digits, we have to look at an economic mechanism the CEO referred to as lapping.
Lapping.
Yeah.
What exactly are they lapping? Are they running track?
Kind of. Think of it like looking at a town's umbrella sales.
Okay, umbrella sales. I'm with you.
Imagine in 2021, this town experienced a massive, totally unprecedented hurricane season. It rained for weeks. Everyone panicked and bought an umbrella.
Because they had to.
Right. So umbrella sales spiked by, say, 500% that year. Now we are in 2026. It is just a normal, moderately rainy spring.
Just normal weather.
Exactly. But if you compare the umbrella sales this quarter to the hurricane year, they're technically down double digits.
Ah, I see. But that doesn't mean it stopped raining altogether. They're just comparing normal weather to a natural disaster.
Exactly. The transcript notes this drop was driven by the difficult comparison of lapping outsized share gains from 2020, 2021, and 2025.
Because during the pandemic and its immediate aftermath, e-commerce just exploded overnight.
It was a tidal wave. Logistics companies were utterly overwhelmed.
They couldn't keep up.
Right. To survive the sheer volume of packages, they had to scale up their automated tracking capabilities instantly. They bought every RFID label they could get their hands on.
So Avery Dennison experienced massive, unprecedented share gains in the logistics sector during those years. They were selling RFID labels as fast as they could possibly manufacture them.
They were operating with a hurricane-force tailwind behind them. Now, consumer behavior has normalized.
We're out of the hurricane.
Yes. E-commerce is still a massive, massive portion of the economy, obviously, but that initial hyper-accelerated panic scaling phase is over.
So when Avery Dennison compares their Q2 2026 logistics sales to that abnormally high baseline, the percentage looks like a severe drop.
But it's just a statistical hangover.
Think about your own Amazon orders, listener. A few years ago, you were probably getting a box on your porch every single day, maybe twice a day. Now maybe it's 2 or 3 times a week.
Right, it's just normalized.
So Avery Dennison's double-digit drop in logistics isn't a shipping crash. It is just a reflection of your own return to normal life.
Exactly. And the CEO acknowledged softer overall customer demand in the segment, yes, but they also noted they are managing through the normalization of outsized volume with our largest partner.
While also expanding pilots with new customers, I saw.
Yes, which is key. It is a return to a sustainable baseline growth curve, not an economic freefall.
That makes total sense. But, it does present a strategic problem for them.
How so?
Well, if one of your massive growth engines like logistics during a pandemic starts to cool off and normalize, you have to find the next frontier. You have to find a new massive industry to digitize to keep those growth numbers up.
And the transcript drops a huge clue about where Avery Dennison is placing its bets.
Yeah, it does. And it is a place you and I visit every single week.
The supermarket.
The food sector. Strategically, this is arguably the most transformative initiative discussed in the entire call.
I agree completely.
The CEO gives this massive tease in the transcript. He says that in the food sector, they are positioning the platform for accelerated expansion.
Exciting words for Wall Street.
Very. And then he says they're expecting to see a significant uptick in the back half of the year, driven by the beginning of a rollout with the largest U.S. grocery retailer.
Now, if they connect this to the bigger picture, the implications of the largest grocery chain in the United States adopting item-level RFID tracking, they are staggering.
It's game-changing.
We really need to talk about why a grocery store needs this technology, because it is fundamentally different than tracking a t-shirt or a soccer jersey.
Right, because grocery margins are notoriously razor thin. We're talking about pennies on the dollar for profit.
Exactly. And the ultimate enemy of grocery profitability is waste, spoilage, what the industry calls shrink.
Shrink, right.
Think about the complexity of managing a modern supermarket. You are dealing with tens of thousands of perishable items.
All expiring at different times.
Yes. A carton of milk has a different shelf life than a package of ground beef, or a bag of spinach, or a loaf of bread.
And historically, inventory management in this sector has been highly manual, incredibly labor-intensive, and just prone to human error.
We've all seen it. We've all seen employees physically walking the aisles, picking up individual yogurt containers one by one to check the expiration dates printed on the bottom.
Oh yeah, just flipping them over, making a stack. It is incredibly inefficient.
Now, consider the mechanics of how an RFID tag actually works to solve this exact problem.
Okay, walk us through it.
It is not a barcode that requires a laser to see it line of sight.
So you don't have to scan it physically?
No. An RFID tag contains a microscopic silicon chip and a tiny radio antenna.
Wait, a chip on every single label?
Every single one. So when a grocery worker walks down the aisle with a handheld reader, the reader emits a radio wave.
Okay.
That wave physically powers up the sticker on the milk carton, and the sticker beams back its unique digital identity.
Oh, wow.
And that identity includes its exact expiration date.
So the worker doesn't even have to look at the milk?
Not at all.
They just walk past the dairy cooler? And the invisible radio handshake instantly tells the store's central computer exactly how many cartons are expiring tomorrow.
That instantaneous visibility fundamentally shifts the paradigm of grocery management.
I can imagine.
A grocery manager can automatically trigger a discount on the meat that expires in 2 days rather than throwing it in the dumpster on day 3.
Which saves them a ton of money.
Exactly. They can dramatically reduce food waste, optimize their ordering so shelves are never empty, and redeploy all that labor previously used for checking dates into actual customer service.
It is a margin protection revolution for the entire food supply chain.
Truly a revolution.
And Avery Dennison is positioning itself right at the bottleneck of that revolution, providing the actual physical tags that make the whole thing possible.
It is a brilliant pivot away from the normalizing logistics sector.
It really is. And that strategic positioning, that new frontier, is likely what gives management the confidence to make the final major move we see in this transcript.
Ah, yes. You are referring to their financial guidance for the rest of the year.
Yes, the 2026 outlook.
Yep.
Let's recap what they are facing right now, just to put this in perspective.
It's a lot.
They're dealing with raw material inflation. They are dealing with geopolitical supply chain panics, causing their customers to hoard inventory.
Yes.
They know a massive, unpredictable wave of inventory destocking is coming in Q3.
The unwind.
And their logistics sector is experiencing a statistical hangover. Despite all of those massive headwinds, the executives at Avery Dennison decided to reinstate their full-year guidance.
They are projecting $10 to $10.30 in adjusted EPS.
And 3% to 4% organic sales growth for the full year of 2026.
Yeah.
Reinstating full-year guidance in an environment this volatile, there's a massive flex of executive confidence, isn't it? I mean, Wall Street heavily penalizes companies that miss their own guidance.
Brutally.
So putting those numbers out there means they are incredibly certain they can hit them.
It is management drawing a line in the sand. They are telling the market, look, we see the macroeconomic turbulence. We understand the complexities of the impending Q3 destocking.
Yeah, I know it's coming.
Right. But we have enough faith in our structural agility that we can confidently tell you exactly where we will land at the end of the year.
It really validates that productivity playbook the CEO kept referencing.
It proves it wasn't just corporate speak.
Exactly. They aren't just crossing their fingers and hoping the economy improves. They have physical, operational levers to pull to protect their margins, regardless of what the broader economy does.
It demonstrates the profound resilience of a truly diversified global portfolio.
Yeah, the diversification is key.
When logistics normalizes and drops double digits, sports apparel booms due to the World Cup.
Right.
When base materials face an inventory destocking unwind in Europe, intelligent food labels ramp up with massive U.S. grocers.
It's a balancing act.
They are constantly adjusting the dials, leaning into the sectors with tailwinds to offset the sectors with headwinds, just maintaining that steady forward momentum.
You know, we started this deep dive talking about how the barcode on your shampoo bottle or the sticker on your apple is practically invisible to you.
Easy to ignore.
But hopefully, listening to this breakdown, you now see that those tiny labels are the physical manifestation of a massive, incredibly complex global ecosystem.
It really connects everything.
The intelligent anti-counterfeit tag woven into the jersey you buy for the next World Cup, or the RFID chip on your next grocery run. They are the end results of raw material inflation battles, geopolitical hoarding strategies, and corporate agility happening on a massive industrial scale.
The everyday products sitting in your home right now are literally covered in the fingerprints of global macroeconomics.
Which brings me to a final thought I want to leave you with today. We spend so much time watching consumer confidence indexes or, listening to talking heads debate the stock market, trying to figure out where the economy is headed.
We all want to know what's next.
Right. But if a B2B materials company, a company that operates entirely behind the scenes, just making the labels and the adhesives, if they can see shifts in global retail recovery, logistics stagnation, and geopolitical hoarding months before those trends actually hit the consumer's wallet.
It makes you wonder.
Are corporate earnings calls for supply chain companies actually the most accurate crystal balls we have for predicting our own personal economic futures?
It is a profound question, because we are looking at the architects and the structural engineers of the global supply chain here.
Yeah.
And usually the engineer knows the building is leaning long before the people living inside it even feel the floor tilt.
Such a great way to put it. Something to ponder the next time you peel a sticker off a new purchase. Thank you so much for joining us on this deep dive into the invisible forces shaping our world. We will catch you next time.